No, I think when we started this journey 12 years back or 11 years back, we didn't actually aspire to really, we didn't think that we'll get to become equity market leaders. And of course, so I think first of all, I must thank all our partners, our MFDs, because without them, actually, a lot of this would not have happened. Uh, I think the key three things, Nishant, for me are one is obviously consistency. That's what we have seen. I think, irrespective of what market conditions are, whoever is here, I think the fund has always had a certain consistency in investing and in communication of its philosophy. So the philosophy has been broadly very, very clear. So when a partner or an investor gets into the fund, he or she knows exactly what they're going to get. Right? So that's I think the biggest one. We've not really got swayed by trends. We've not got really swayed by markets, and that I think has helped us. I think number two is again the investor experience. So obviously, when you have a certain consistency in approach, there are certain periods where it does very well, certain periods where it doesn't do very well. But if you look at the long-term track record of the fund, and especially when markets correct, I think the investor experience has been very, very solid. And I think that's also reflecting in the fact that we recently crossed a 1 crore folio mark, which I think is also reasonably unique for a fund as young as ours, especially when you're in an industry where many of my peers are much, much older to us in terms of existence. I think the last thing is, I think, like I mentioned in the beginning, our partner conviction in us has been very, very powerful. And that's helped us build a very strong SIP book. It has helped us get flows despite having near-term performance issues. So I think people are very, very happy with their experience with Access, be it communication, be it reach, and yeah, I think these are to my mind, the three big things that have helped us. I think it's broadly more of the same in terms of, because as I said, Nishant, we are not going to change our equity philosophy. We're not going to change our fixed income philosophy. I think there are three or four pockets where we like. I think one is obviously the entire alternate investment suite is something that really excites us. I think our job is to try and find sustainable alpha for investors, and I think that's one area where we think there is some alpha available. So we are in fact diversifying into late stage equity, private equity investments. We're diversifying into credit AIFs, and that's one part where I think our partners should also be happy. It sort of broadens the suite out. We have been late entrants in the passive business, but I think we are trying to get there. I think that's another very exciting area for, especially for partners today. I think there is not much excitement because obviously the fee structure is a little low, but I think there's a reasonable amount of customer pull. So I think you have to get there. I think obviously the whole digitization scope is fantastic. And today, I think thanks to whatever has happened in the past couple of, especially in the last couple of years, have only actually increased that. So I won't be surprised sooner than later where this whole process of filling a form and submitting it and getting an acknowledgement and then check getting banked, all that story is over. In fact, more than 90% of our transactions actually come practically offline today. I mean online, on in the DMAT mode or in the electronic mode. So I won't be surprised like very soon, and I'm willing to make a statement that I guess by 2025, my guess is that the whole physical infrastructure of having forms and fact sheets and all that will actually completely get digitized. So that's something that we want to do, and it's something like buying stuff on Amazon. First couple of times it's a bit scary. Investors do have a little bit of apprehension. Partners have apprehension, but I think once you get used to it, I think there's no going back. So suddenly your productivity levels really takes off. And that's something I'm a big believer in because I think if you really want to 10x your business, which I think all my partners can do today because the market is like that, I think the way to do it is to try and get more digital focused. And it's not only about the transaction, it's also about the way you communicate, what kind of data mining you can do with your existing set of customers. So that's a big area of focus for us to try and get our partners to improve and increase their total business. When that process Axis AMC also tends to get a good share. So yeah, alternates, passives, and obviously deepening the client relationships with our partners is something that we would like to do, and obviously continue doing more of the same. Fixed income is something which nobody is really talking about today because of all the volatility, but I'm a firm believer that you have to have fixed income in your portfolio. You can't ignore it. You have various ways to do it. You can do it directly through a bond or through buying a PPF or anything else. But the fact is that, or you could buy through a mutual fund. I think mutual funds play a very, very beautiful role there. And I think partners have to start thinking about fixed income more constructively, despite the near-term volatility that is happening. And I don't think they should lose their expertise in fixed income. So if I were to put it broadly, more of the same, but obviously trying to get more passive investments, trying to get more alternate investments, and then of course making sure that fixed income continues to be a good part of the allocation. It's the 3-4 things that I would like to focus on. I think first thing is, I think number one, it's a category which is created a lot of wealth for investors. So if you ask me today, it's a great uh, it's given a great experience to investors, especially if they've hung around for a fairly long period of time. So I think equity on its own is a great wealth builder, and you know it better than I do, Nishant. But of course, equity comes with its set of volatility. Now, to take care of that volatility, the longer you hold, the better it is. So that way, ELSS has a natural advantage because you are compulsorily locked in for a minimum period of 3 years, right? In fact, a lot of our investors actually don't use our long-term fund, which is our name for the ELSS, Access Long-Term Equity Fund. They don't use it as an ELSS. They actually use it more as a goal set. Because if somebody's got a 5-year goal or a 3-year goal or a 7-year goal, they typically tend to get into such products because then, irrespective of market volatility, they can't take it out. Number two, you know that after 3 years, the equity part of it is practically tax free. Just pay 10% tax. There also, if it's typically a small investor, up to 1 lakh rupees a year, there is an exemption from tax. So a large part of your returns, especially if you're a retail investor, tends to come back to you almost tax free to you. So that's a great thing. And then lastly, of course, it's got the shortest option, right? Other options have much longer uh, periods of investment, right? And like for example, a PPF has a minimum 7-year lock-in, NSC has 5-year lock-in. So these things this has a 3-year lock-in.
Right.
So I think all this put together is a great way why ELSS schemes are continuously getting inflows even today. I think in Axis, what we did long time back was we changed the name. We were the first people in the industry actually to not call it an ELSS fund.
Right.
Of course, it is an ELSS fund, but we called it long-term equity fund. I think the fundamental thing is that if, my belief is that if you can get a goal attached to every investment, the MFD becomes much, much easier. Life becomes much, much simpler for her. So I think if you can, ELSS should be in some sense marketed as a 3, 5, 7, 10-year product with a minimum 3-year lock-in. So I think that's number one. Number two, of course, if it's a first-time investor, all the things that we spoke about in terms of low lock-in, equity exposure, convenience of investing, all that is great. And number three, last and most important, is that typically we see a massive rush of investors coming in during November, December, January, because that's when the tax season really hits you, and you have to provide all your investment proofs and stuff like that. Whereas I would, and I think that's where a good partner helps, because you can then sort of stagger that money out over create an SIP, so that you're not really worried about last minute stress, November, December, January. And so I think if you do a combination of SIP plus wealth creation, all right, and of course encompassing the good things about ELSS, I think you should. It's an easy sell today, if you ask me to. The level of earlier in the past, we used to have a lot of challenges explaining to investors, what's the difference between this and other 10-year, 15-year instruments. But now, like if you take Axis, the ELSS fund itself, we are now 11-year fund. We have a wonderful track record over that period of time.
Right.
And it's not only for us, large parts of the industry have completed a decade, 15 years. So you have a good long-term wealth creation track record, especially in this category. If you can show that, I think that itself is a very, very powerful thing. Lastly, I think, investors are emotional. We are all there. And especially when you're going through markets like we are going today, we see sometimes that they sometimes tend to pull out the money at the wrong time. So an MFD would have convinced and taken a lot of effort to get that investor on the table, but suddenly the investor sees 5, 7, 8% correction, and that can happen, like what is happening in the last, especially 3, 4 months, for reasons which are not really fundamental. They are actually more liquidity driven. They are more FI driven. So the investor then just sometimes tends to get very upset and just pulls the money out. ELSS, at least you know that your money is there for 3 years, so it has a very good long-term ability. So from an MFD earnings perspective, at least you have a certain certainty of some level of earning for the next 3 years. So I think that's the most important part of it. I'm a firm believer of SIPs in especially in ELSS, Nisha. Because see, lump sum, especially when you're dealing with ELSS is obviously based on a certain deadline. Then, irrespective of the market level, one is forced to invest at that level because you have a deadline to submit your investment proofs. You have a deadline that you have to invest before, say, the last working day of the year, right? And then, obviously, with you know, to make sure that the money gets credited, a account statement comes to you. So, if you just why go through that stress, just set up a nice SIP in the beginning of the year and just keep putting whatever you want to put away in ELSS. So I am a big believer in that. So that way you get the benefit of market volatility. You're not stressed in the last date, and it's a very smooth ride. I see many of my MFD friends getting upset that are so typically you will come in the last day and you will try and put. It's like rushing an investment, which is not the best thing to do. Because I really don't know, for example, where markets are going to be in the next 1 month. And let's say some investor has postponed his decision. He has no choice but to invest by March 29th, which is the last working day of the month. So, I mean, of the year. And that sometimes tends to crowd and sometimes you take bad decisions because of it. So I'm a big believer in SIPs, at least in ELSS, if not anything. Yeah. I think three things, as I said in the beginning, is that we are known very well for our consistency of what we talk about, of our process. Right? I think Axis has always been known to invest in high quality companies. High quality companies which are sustainable and which have high levels of governance. And in fact, we were following the ESG principles long before it became fashionable. All our funds, including long-term equity fund, are ESG compliant. In fact, they have the highest rating. What this does for you is it gives you a good long-term ride, but in the short term, because of various conditions, it can get skewed. So, in the last 1.5 years, it's been a very momentum-driven market. Why has that happened? Because of excess liquidity, low interest rates. So people have been actually chasing stories rather than fundamentals. Our belief is that these all run in cycles, correct? So when the fundamental story starts coming back, you will see Axis bouncing back. In fact, if you have a year, 2022 is expected to be a reasonably bumpy year. You have too many things happening at the same time. Oil has gone up, interest rates are expected to go up. There is massive geopolitical tension, possibly the highest in the last 1 decade, and that can lead to a lot of unforeseen things. In such situations, strong companies with strong fundamentals are the ones that eventually stand out. Right? Stories don't tend to stay a story for a long period of time. So the moment we go back from being a momentum or a liquidity-driven market back to a fundamental-driven market, Axis will do. So we are not making any significant changes to our portfolio. We are very, very bottom-up in our approach. We are very, very company-specific. We really don't have any sector calls. We are in that sense, we are not very benchmark hugging also. So we will take reasonably diverse bets if we find that companies are very good. So we are not really changing our process or our style of investing. And that has helped. I mean, if you look at Axis funds on a 3-year rolling return basis, we've never given a single instance of a negative return. And in fact, about 70% of the time on a 3-year basis, our funds have delivered a 12% CAGR. That number is hardly 40% for the industry, which I guess is also one reason why we are possibly well recognized in the equity space, which is also possibly why we are number one in equity. Right. So I think from if you marry that and you marry the Axis brand with it, I think it's a good combination for people to trust. So I don't think we are doing anything there. So I think we are staying to our fundamentals. We have seen this happening in the past. So when 2016. Similar situation happened. You had a lot of froth in the market, and markets went completely haywire. And that year, Axis didn't do very well again. It was very similar to 2021. And 2017-18, we bounced back with a vengeance. Because stories can take a stock only so far. Ultimately, then it is the underlying fundamentals which will drive the future performance of a stock. Right. So if your fundamentals are not strong, ultimately those companies tend to correct very, very quickly. So I think I'm reasonably confident that and that's one reason why a lot of our investors in Axis long-term equity have tenures of much higher than 3 years. In fact, most of them are in the 5-year bucket. So and they are happily invested right now. So I don't see that to be a challenge.
Okay. So, Raghav, I would like to ask you, what is your take on the rise of volatile? What do you think? What is the impact of volatile on the market? And what are the risks? What are the risks? And what are the opportunities? What do you think?
I think, Nisha, I think, 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 think, like I said, we are going in a year of volatility. So I think you can't do the old. Uh, you have to keep your ears and eyes open. Like, I think number one. I don't want to make predictions on small cap, mid cap, large cap. I think if you ask me, it's very company specific. So I think people tend to put all of these things into buckets and say small cap will not do well or mid cap will not do as well and large cap will do well. I don't think it's that. I think good companies across all the three segments. If you have a good company which got great fundamentals, they will eventually catch up, even if the stock is not done well in the recent past. Right. I think the other thing, like I said in the beginning of the call, we will possibly. I think MFDs need to keep their ears and eyes open for other investment opportunities. There's a lot of stuff happening around early stage investing. There's a lot of stuff happening around structured credit. There's a lot of things happening around turnaround. And MFDs have a reasonably diverse client base. Many MFDs have very, very large HNIs they cater to. And if they can keep their clients close to them and keep the requirements close to them, they may find that it's easy, much easier to for clients are now adopting the alternate routes also. They're happy to listen to you. Earlier in the past, we used to always think MFDs are a 1 crore application. How will an MFD give? I don't think that's the case. And I think MFDs have had a very, very good experience. Clients have had great experience with MFDs. So they're willing to cut large checks in favor of the MFDs. So, earlier the trend used to always be, Nishant, is that the MFD caters to the retail part of a client portfolio, which is his SIPs, his tax planning and other things. And some other large managers or wealth managers will cater to the so-called complicated thing. But life is not complicated. I think there is enough of work, and I think there's a lot of information. Your channel is one of them, which actually demystifies a lot of things. So they need to keep their ears open. Second thing I keep saying is that fixed income you cannot let go. Irrespective of what has happened in the last 12, 15 months, you have to have a reasonable allocation of money to fixed income. And I think that will get more proved in the next 3-4 months. And every time you see a market correction, ultimately the client wants to look at his return on portfolio.
Right.
So if a client is very, very skewed towards equity, I think you are going to find it difficult to explain big drawdowns and especially what's happening. So if people are thinking, no, this is a first quarter phenomenon, next quarter things will get better. My belief is no. I think 2022 is going to be a very, very choppy year. It is not a, and I think of course we have always seen that when you invest in years like this, that's when the investor has the best experience. The challenge is to get the investor to invest. And for that, you need a reasonably stable fixed income portfolio. And I think there are many strategies available. There are target return funds now, which are giving you a portfolio yield of more than 6.5%. There are mixed funds which have a AAA, AA, which again are in the 6.5-7% range. There are 5-year plus duration funds. And of course, we have the whole less than 1 year segment, which is now quite nicely gone from about 3% to about 4.5-5% return. So, through a combination of all of this, I think you need to have that little bit of buffer, so that when the investor is looking at his total return, he gets a comfortable feel. Right? The other thing, and hybrids, of course, are a great story. That's something that we've been always we like. But yeah, if an investor wants to see equity and debt separately, I think you should have a bit of both. I think in the last 2 years, that allocation has got skewed a lot. So maybe some reallocation should happen. I think that's about it, yeah. I think in fact the MFDs are in a sweet spot because I think the last 2-3 years the returns have been absolutely fantastic. Today I can confidently say that there is a bit of a pull factor for mutual funds. When I started my life 20 years back, it used to be push. In fact, mutual funds are not even in the scheme of things, and there's a massive opportunity because I think the existing investors only are putting more and more money. So I think there are new investors if we can go out and get some way. And I think the AMFI campaign on MF Sahi Hai and all the other things that we are doing will actually help you get more traction into this thing. So I think it's a great time to be an MFD. Yeah, earnings are going to be volatile because markets are going to be volatile. So in that sense, we have partners today. So as and when NAVs go down, and that's going to be a bit of a challenge. But I think the investor has now become quite smart now. So I think the questions that I used to get in the past when markets used to collapse are no longer coming to. In fact, people are looking at every dip as a buying opportunity right now. So actually that's good. So I think the MFD needs to possibly change his or her style of operation and maybe make it a little more informative, make it a little more customized, and maybe deepen it a little. So I think today that 80-20 rule is very, very applicable to an MFD. Yes, so that 20 has to actually go to 40.
Mm.
So that today 20% of your clients are giving you a lot of money. How can I double that? Maybe how can I deepen that book? I think that's something that they need to start thinking about. So I think it's a good time to be an MFD because it's a especially people who've seen cycles, and
Mm.
the MFD in that sense is a very good person to hold in investor's hand. They've got time on their side. They've got relationships. They can utilize that. I think it will be very, very good from a long term basis.